Hello and welcome. Hope you all are safe and doing well. We are back with a new Fresh Talk this weekend. Thank you all for enrolling in this event. Excel in Excel welcomes you all. Let me give a gist of Excel in Excel. Excel in Excel is a data analytics firm that solves high impact business problems using data and technology. We provide end to end services in the field of data analytics and data visualization. Our core services include analytics, consulting, and training. Excel in Excel presents the popular talk show EIE Fresh Talk on its YouTube channel, where it hosts great leaders and subject matter experts in various fields from India and abroad to speak regularly on variety of topics ranging from Excel to analytics and finance to financial modeling. Few of our past events are Best Practices in Financial Modeling by Daniel Steen Fairhurst, Modeling a Franchise Business Opportunity by CA Sandeep Kothari, 7 Excel Features Pros Used to Be More Efficient by Sumit Bansal, New Formulas in MS Excel and its Use Cases by CA Vijay Agarwal, 5 Must-Have Charts in Any Finance Person's Toolbox by Chandu, and Secret Lookup Functions That Deserve Your Love by Mr. Alan Murray. Today's talk is about how to build a professional looking financial model presented by Mr. Tim Heng. Mr. Tim Heng has over 15 years of experience in developing and reviewing financial models across a range of industries and sectors throughout Australia and internationally. He develops modeling solutions for business challenges using a combination of Excel, VBA, Power BI, and database analytics. He has worked across the world with clients in Australia, Canada, Hong Kong, Indonesia, Japan, Malaysia, New Zealand, Singapore, United Kingdom, United States, and Vietnam, as well as numerous projects based throughout Africa. Mr. Tim has written articles for the newsletters published by the Society of Actuaries and has been a regular presenter at conferences, training courses, and webinars for Chartered Accountants Australia, New Zealand, and CPA Australia. He is recognized by Microsoft as Most Valuable Professional since 2017. We welcome you, sir. Before we begin, I request the participants to join me in welcoming today's speaker with a hi in the chat section. If you have any questions during the presentation, please type them into the question box. We will present it to the speaker. Over to you, sir.
Thank you, Nidhi, and welcome to everyone who is viewing. Let me just share my screen quickly so we can see what's going on. So welcome to our session. As Nidhi said, my name is Tim Heng. I'm the director of a company called Some Product. I run a consulting firm in Australia. So I'm based in Sydney in Australia. It's currently 10:30 at night for me, so please forgive me if I'm sounding a little bit tired. By the time the session finishes, it'll be nearing midnight. So I'm looking forward to spending the next hour and a half sharing some different tips and ideas on how to go about building professional looking financial models. I think Nidhi has given a fairly good description about what I do, but generally speaking, I didn't start off in the financial modeling space. I initially started working in credit risk and analytics, working with big data. And from there, models and spreadsheets were, they were about utility. You get the job done, you get the question answered. They're not necessarily there to look particularly professional when you're working in an organization rather than as a consultant. And so in 2010, when I basically moved from the world of corporate into a consulting world, it suddenly became very apparent that while I knew how to build a model and I was competent in Excel, I wasn't necessarily building them in ways that would wow a client or make someone really think that I know what I'm doing. It gets the job done, but it doesn't necessarily look professional. And so over the last 10 years, I've basically been learning new ways and new techniques to go about building better financial models. Not just financial models as well. These could be dashboards, they could be operational models, they could be any sort of spreadsheet that you might build. I will often build spreadsheets for my family, looking at things like budgets or holiday planning checklists and so forth. Even then, I'll still go to the extent of making sure that the spreadsheets look professional and look like a professional has made them. Taking pride in your work, making sure that everyone can see that you know what you're doing. It not only creates trust in the work that you build, but it means that people look at a spreadsheet and trust it more generally, and feel like it's going to work better. So there's all reasons to go about building professional looking financial models. The reason I actually came up with this topic, both for this session and an Excel session that I ran a couple of weeks ago at another conference, is looking at the situation that we find ourselves in the world right now. Clearly, the COVID pandemic has been going around the world and is causing a lot of personal health damage as well as economic damage. One of the big, problems that's going around the world, in addition to just the simple health cost, is the unemployment rate. The fact that unemployment in some areas has doubled or tripled or even greater. And for those people who are looking for jobs, it becomes very difficult to try to stand out from the crowd. It's hard to make your skill set seen more favorably compared to other people who may also be applying for similar roles. And so it got me thinking, what can I do to help people find a better way of presenting their skills? Because certainly when I was applying for jobs a long time ago, I think, to be honest, the last job I applied for was 10 years ago. So it's a little bit difficult to recall what I was like exactly back then. But as I mentioned before, I wasn't a consultant back then. I was building very utilitarian models. They did the job, they got the answer, but they didn't look good. And so when I was putting the session together, I was thinking, what could I kind of show people to make their spreadsheets look better? Because a lot of if you're in the Excel space, a lot of the time your job interview may involve building some sample spreadsheets or a spreadsheet tests to see how competent you are at Excel, or how well you can build certain types of models or do certain tasks. And I find that the quality of models that come out of these sort of testing processes, and this is speaking now as someone who runs these tests to hire people into our organization, we find that the quality of models that get produced tends to be very lacking. There's a lot of different professional techniques that aren't being used by people, or alternatively, they are being used, but then they're being showed up by some fundamental flaws and problems that people are exhibiting in other areas. So I thought I'd put together this session to kind of highlight some of the things that set apart an amateur sort of financial model from a professional looking financial model. Something that's actually going to wow someone who might be looking at your work. It could be a boss, it could be a colleague, it could be your friends and family, it could be an interviewer. We're basically going to talk through some different techniques that you can use, not to completely change the way you work, but simply perform a couple of tweaks to the things that you're already doing to elevate it and make your work that much better. So that's the goal of this session. We're not going to try and overhaul what you're doing. We're simply going to make some simple little tweaks to make your Excel models more professional. So with that, why don't we get started? Here's the agenda for this session. We're basically going to learn how to look like a professional modeler. So I believe that Danielle Stein-Fairhurst has run sessions here previously on best practices. Thought I might reiterate a couple of best practice points from a different perspective. I think every firm and every individual modeler has their own idea of what makes good practice or best practice. I'll share a couple of my thoughts as well, and maybe people in the chat can let me know what you think and how that compares to what you've seen elsewhere. We're going to use a simple example of VLOOKUP. A VLOOKUP is probably one of those really common functions that people use when they say, I know how to build financial models, I'm good at Excel, I can do a VLOOKUP function. We'll take a look and see how to make that stand out, because a lot of people can use a VLOOKUP, but what would a professional use? How does it look? What are some of the issues that you can run into when you're using a VLOOKUP? And we'll talk about what other options there are available that may actually impress people more if you're looking to sort of show off your skills. We'll then go through a bit of a case study. We'll take a look at a financial model that's been built that's, I guess, fairly not professional, a bit amateur. And we'll go through a series of steps to basically turn it into a professional looking financial model. So I've built a simple model that looks like a lot of the applications that I get for jobs. And what I'm going to do is basically just spend 20 to 30 minutes tweaking it up and turning it into something that looks like it would have been a professional build built by a consultant for a client. So hopefully that will show you how just little simple tweaks can actually make things look a lot better and a lot more professional. And throughout this whole process, we'll highlight some different takeaway tips and checks that you can easily apply in the process of building your files. It shouldn't be a case that you build a file and then it's, that's it. You don't check it. There are some really simple tools that you can use that are built into Excel that will make it easy to find common errors that make you look really amateur. So we'll cover those as we go, and it's not like we're going to cover that right at the very end. We'll be talking about that at different points in time. Now, I've mentioned to Nidhi previously that I'm happy to try and answer questions as we go. So I understand that there is a bit of a lag between what I'm presenting and what you'll see over on YouTube. If you're watching this after it's been recorded and posted online, that'll be a very big lag, and clearly you're not going to be able to ask questions at that point. However, for those people who are watching live, you're welcome to ask questions. I think Nidhi is probably going to be looking through, and if there are any particularly good questions that are worthwhile sort of interrupting the presentation to try and answer in context, we'll see if we can answer those as we go. Otherwise, we'll aim to answer any other questions at the end of the session. So with that, why don't we get started? All right, so in terms of what makes a professional looking model, we talked about best practice. I'm going to talk about what I consider to be best practice. So the key concepts that we have in financial modeling, and I say we because I'm talking about some product as our company that I have. The four key concepts that we try and adhere to is this notion of consistency, robustness, flexibility, and transparency. The idea is that if you're trying to work out, is your model a good model? Is it a professional looking model? Rank it against these four characteristics. Is it consistent? Is it robust? Is it flexible? Is it transparent? And if what you're doing is moving closer to being more consistent and more flexible and so on, then you're building a better financial model as a result. So what do these things actually mean? Let's go through them one at a time. Consistency. This is the idea that you will have consistent blocks of calculations, or you'll have consistent formulae across the entire length of a row or the entire height of a column. The idea is that this consistency means you make fewer mistakes. The model has more integrity, makes it easier for developers and easier for users to understand how the model works. So as I said, this could be formulae that are copied across a row. A lot of people will have seen models where formulae are changing partway through. So I was literally looking at a model earlier today where there were 12 months of calculations, and the first 3 months had one formula. The next set of 3 months had another formula. Next set of 3 months had another formula, and so on. So in this 12-month forecast, there were 4 different formulae that were across the line. This is not consistent. That makes it much harder to follow and understand. It means that you can't just look at the first column and assume that that formula works and flows through the rest of the model. There's the second part of consistency, which is around building structures consistently. So for example, I've got a model that I just built for a client where they've got 40 different business units. And the idea is that these 40 different business units are generally identical. They've got different characteristics, but I've built a template structure that works, that can be applied to all of those business units. And so I set one up, and that works, and that's fine. And what I can then do is copy and paste that 40 times to generate the 40 different business units. And in that sense, rather than having 40 unique sets of calculations, having 40 blocks of the same calculation is much more consistent. It means that there's less likely to be errors. You're likely, every time you put in a new unique formula, you're more likely to create an error in that process. When you put a unique formula in, we create errors by linking it to the wrong cells, or pointing to a blank cell, or simply just getting the logic wrong. And we can do this just through accidentally typing a wrong key even. Human error is a really common way of making mistakes in financial models. So it's worth remembering that if you can make these consistent calculation blocks, it's a lot easier to build models that have better integrity, that have less mistakes. And if you need to fix those mistakes, you fix it in one section, and then you can copy and paste it to all the other sections as well. So it becomes really easy to work with these models and to build and enhance these models in the future. So let's take a look at some examples of how this might work using predefined formats and styles. So you've got consistency, not just of formulae, but of formatting as well. Mentioned having formulae copied uniformly across ranges, and presenting data and formulae in columns consistently. So by this, I mean, if you've got several different sheets that have a time series, that maybe they should all start in the same column. So it's a bit weird when January is column N in this sheet, and it's column J in another sheet, and column F in a different sheet. If you can put them all in the same column, then it's much more consistent when as a user is looking at the file, but also as a developer, when you're working with the file, you know that column N on one sheet is the same as column N on the other sheet. And it's much easier to see how links between sheets work together. So this is a consistency. Let's move on to the next point. The next point is robustness. We want models to be free from error. We want them to be accurate and easy to audit. So when it comes to auditing, and this is one of the things that I've done as a consultant for the last 10 years, model audit. Auditing is a completely different kettle of fish to actually building a model. When you're building a model, often what you'll try and do is make it easy for you as a model builder. But often what that leads to are very big formulae that are then hard to check and hard to understand. So when it comes to robustness, the key thing here is to make sure that it's not just easy for you as the model builder to understand, but for the model user or the model auditor or whoever's on the other side of the model, you want to make sure that they're able to understand it as well, and that it's easy for them to follow. And so if you keep things simple, if you keep them consistent, if you keep them transparent, there's all those keywords again, those will generally be more robust models as a result. So you want to have models that have that are structurally good, that have logical and formula strength, sturdiness, right? You want them to you want to use simple formulae that aren't overly complicated. You want to have error checks in place to make sure that users aren't accidentally entering in the wrong data. There are lots of things about robustness, or checks in place to make sure that, say, a balance sheet will balance. These are all things that you can use to make a model more robust. Look at flexibility. Models should always have the structure to provide what-if analysis, the ability to change assumptions and inputs in order to see what the outcomes are on the other side. I remember working as a consultant, looking and training a team on a project that were using a model that was built by an investment bank. And this project was a $60 billion transaction. So it was a liquefied natural gas project off the coast of Australia. This entity had $60 billion worth of capital expenditure, and they were borrowing $20 billion from different government credit agencies and $20 billion from different banks around the world. And when they modeled interest rates, or the interest that they were paying on $20 billion worth of loans, they had it as a hard-coded 4% per annum value that was in every cell in the calculation. There was no input that you could use to change the interest rate from 4% to 3% or 4% to 5%. There was no input to be able to change the interest rate from this year to next year or the year after. And this breaches the flexibility rule. And it may sound a little bit weird that I'm highlighting examples that aren't best practice, but to me, I think the best way of trying to describe what best practice is almost to show what best practice isn't. These concepts of what is a bad model is almost just as good as understanding what is a good model. So here's this $60 billion transaction. If you're running a bank, or if you're deciding whether to lend money to this company, do you rely on this model? That's essentially the question. Do you have faith that this model is going to give you the right answer? And if you don't have the flexibility to test different scenarios, how can you trust what the model is going to do in the future? And so when I was working with this team, it was less about sort of building the model right, because that had been done and the transaction had been completed already. But in our case, it was teaching the team who are owning the model how to go about modifying it so that they can run their analysis in the future. So making sure that they can build in this flexibility. So flexibility. The final topic, transparency. Models need to be clear, concise. You should have assumptions that are set up and calculations that are separate from those assumptions, outputs that are separate from those calculations and assumptions. It should be very easy to identify. It should be user-friendly to work with. So another example of where this doesn't work, I had a file that I was working on that I needed to rebuild for a client. And they had an assumptions page. And so naturally, the first thing I want to do when I'm looking at a file is start changing some assumptions around and see how does that flow through to the end result, the outputs. And I changed some assumptions and nothing happened. And so I ended up going to the outputs and then tracing formally back to find, where do these numbers actually come from? And there's an assumptions, there were suddenly some hard-coded numbers that I found in the middle of the calculation block, buried 900 rows down the page. It was very non-transparent. The idea is that you want to have a dedicated assumptions page, a dedicated calculations page, because that means that when you go ahead and open a file, if you haven't built the model, you don't know where to go. So having everything consolidated on one page makes it much more user-friendly and easy to follow. We can go about using styles and formats to highlight the assumptions that people should change, and highlight or change the colors of things that people shouldn't change. So these are some ideas of how you can build transparency. You can also try and do things that aren't unfamiliar to other people. So don't use uncommon or really weird functions that people don't know how to use. Try to avoid using array functions. I know that in the Excel space, a lot of people like to use arrays to solve problems. If anyone goes on to Reddit and looks at the r/Excel, you'll see that all these people have these complex problems and everyone tries to solve them using these gigantic sum product array formulas. And we've got dynamic arrays that do a similar sort of job now as well. And the thing is, that just adds complexity and makes it unnecessarily complicated. Often, the more transparent way to go about it would be to add a column to perform some sort of interim calculation and then provide the answer, rather than using a complicated array function. And just by adding that column, you add this extra level of transparency that makes it easier to follow. So this is where transparency is important. It's making sure that things are user-friendly and easy for others to understand and work with. Now, taking these four concepts together, let me just quickly jump back to that first slide to show you those four concepts again. If we're looking at these four concepts, these things sometimes are naturally going to work together, and that's great. If you have something that's more transparent, it'll often be more robust. Brilliant. However, there's going to be some things that often conflict with each other as well. So I remember working at another consultancy previously. There was a rule that said you should always keep assumptions and inputs that you have on an assumptions page and never on an output page. But then we had an output page where that was powered by an assumption that would allow you to change the month. So when you select a different month on a dropdown, the output changes from April to May, May to August, and so on. And the logical thing to do here would be to put the assumption on the output page itself. So at the top of the screen, you use the dropdown and then the rest of the page changes. That makes a lot more sense than having to go to the assumptions page, change the assumption there, then go back to the output page to look at the result. Now, that is a trade-off between consistency, having all of your assumptions on one page, versus transparency and flexibility, the ability for someone to just come through and understand how it works. You see the assumption at the top of the page, you change it, and your numbers change. Simple as that. And so when you're actually trying to make decisions about how do I lay out a financial model or how do I build my financial model, it's a balancing act. It's not a case of saying these are the rules that you must follow to the letter, dot every I, cross every T. You instead should be making a judgment call based on what you think adds to these four qualities. And if you need to balance off one quality compared to another, then that's something that you should do. You should make that call as a professional. So generally speaking, I will often err on the favor of transparency because I think user friendliness is more important than anything else. And I hope generally that when I do things that are transparent, it tends to be fairly consistent, robust, and flexible at the same time. So those are effectively the key concepts that I want to highlight. Now, this session is not intended to be death by PowerPoint. So if no one has any particular questions on these concepts, what I'll probably do is jump back to the previous page and look at what are we going to talk about next. So that was all about how to look like a professional modeler and the sorts of rules that you can use to follow to build things in a more professional way. Now, we're going to take an example of, well, we're going to put those different concepts into examples. And so we've got two examples here. The first one is what happens when we use a VLOOKUP and how can we make that more professional. And the second one is looking at this model case study and making that look more professional. So I'm going to just open up a blank Excel page and we can start working on a simple little VLOOKUP example. So I'm going to type in some data here into a table, and I'm assuming that if there's any questions, Nidhi will let me know as I'm putting this together. But for now, let me just put in some details together here. We're going to have a table of 5 names. And they're going to have different details. and they're going to have different salaries here as well. Now, these numbers aren't necessary, like you don't, if you're following this and you're trying to build this example, obviously these numbers aren't necessary. There's nothing in this example that relates to these specific numbers. You can make them whatever you want. The key thing here is that we're coming up with an example that looks at the name, and we're going to find what a person's salary is. So if I were to type in Billy into this cell, G2, I want to find Billy's salary. And the conventional way to do this is using a VLOOKUP. So let me use the basic form of the VLOOKUP. Equals VLOOKUP. Let's find Billy's name. We'll look for Billy's name in this table, and then we'll pick out the third column because the salary is in the 1, 2, 3, third column. And because we're using a VLOOKUP and we're looking at names, we always want to use a false or an exact match. So this is your conventional VLOOKUP. Nothing particularly fancy with this. This is what the average person will use when trying to solve this problem. Okay, so Billy has a salary of $60,000. Now, the problem with VLOOKUP is that it's very prone to error. And if I were to look at this and someone were to say, look at me, I am good at Excel, I know how to do this VLOOKUP function. I'll look at this function and say, well, actually, you look a little bit amateur to me because there are some problems with this VLOOKUP. And if you were a professional, you'd know what these problems are and maybe tweak the formula or use a different formula instead. So let's look at some of these problems. The first problem is what happens when you insert a new column. Suppose that we have 4 columns, that we don't just have the name, but we also get a new column for the surname of an individual or the address. What happens to the salary? It's dropped to just $26, not $60,000. Why is that? If I go back into the formula here, you can see that the third column now is B, C, D. It's now the age column. And that's because this hard-coded 3 value doesn't change when you insert rows or columns into a VLOOKUP or an HLOOKUP function. The cell references change. You can see it's moved on to column E, but the actual column reference is still a hard-coded 3. Let's undo that. If we were to remove a column instead, we get a #ref error. That's even more dangerous. So these are probably the most common errors that come about when you're using a VLOOKUP function. What happens when you insert or remove columns? And so rather than using this hard-coded value, there are ways that you can adjust this so that it automatically adjusts for your column type. So let me just use the formula text function to show on the right-hand side what the formula is. And let's use a different function now. VLOOKUP, we're going to do Billy's name, same as before, look up these values. But instead of hard coding a 3 value, let's use the columns function instead. And what this columns function is going to do is it's going to look at the number of columns between name and salary, inclusive. So that's going to be 3 columns, which will give us a result of 3, which gives us the correct answer. And when I insert a column, that columns formula is now going to refer to 1, 2, 3, 4 columns, because the columns section also increases in size to E2. Likewise, when I remove the age column, it does the same thing. It now recognizes that the salary is now the second column instead. So these are some, I guess, minor tweaks that you can do to the VLOOKUP function that solve probably the most common error that occurs when you're building a VLOOKUP. This, I would say, is far more professional looking. Anytime you see a hard-coded number in a formula, you know that there's high risk and there's a potential problem. Okay, so that's VLOOKUP and adjusting the VLOOKUPs to make it a bit more professional. What you tend to find is that a lot of people will look to other functions other than VLOOKUP. So you'll often see people using a combination of match and index instead. So if you're not, apologize if people who are watching are aware of how this works. If you're watching the video on YouTube after the fact, then you can skip through the section. If you're watching live, tough luck, you're stuck with me for the next couple of minutes. The match function is pretty simple. The match function just says, where does Billy's name appear in this list? Billy's name is the second item in the list. That's what this match function is doing. And then you've got the index function. The index function basically says, let's find in this list of salaries the second item. And so we're referring back to the match function here to get that result. So index, very simple. Look through our results, find the nth item. Match is also very simple. Look through the list of things that we're trying to find, that we're trying to look up through, and find the item in that list. And so the idea is you can put these together, index match, and have a much more professional looking function as a result, or combination of functions. So if I were to copy this index section here first, so there's our index. And now we know that this is referring to the match result. So what I'll do is go into the match function, copy that out, and paste that into the replacement of G5. So now the index match function together is saying, look through D3 to D7. These are the results. And let's find wherever Billy's name is in the list of names. So this combination is often referred to as index match, and effectively does the same sort of thing that the columns approach did, which is to get around the fact that you have columns that are going to move around. Okay, so between VLOOKUP columns and index match, which is the preferred approach? And I'm going to say that the index match is the preferred approach. There are some streamers out there who believe that the VLOOKUP is perfectly fine the way it is. VLOOKUP is a little bit faster than index match, and in certain circumstances, you might want to use that instead. However, the main reason why I think index match is better is from a dependency perspective. So you may be aware of formula dependencies, trace precedence and trace dependence. The idea is that you can click on trace dependence and you can see what formulae are used or use this cell that I've selected. So if I look at items in the name column, I can see these formulae refer to the name column. Makes sense. Let's remove those arrows. If I look at the salary column, again, I can see these formulae refer to the salary column. Again, makes perfect sense. In this case, both the VLOOKUP columns and index match refer to both name and salary. Brilliant. Let's look at the age column though. What are the formulae that refer to the age column? And quite simply, only the VLOOKUP refers to the age. Index match only point to the name and salary. Whereas VLOOKUP, because it refers to the entire table, refers to this age and any other columns that might be in between. So if you're using a VLOOKUP and you've got 20 columns in your table, then every column in that table is going to be a precedent of the VLOOKUP function. And this is not going to cause errors, but it's going to slow things down because the way Excel works is it looks at what cells are changing, and then it goes through and finds the formulae that refer to those cells using these dependencies to work out whether a formula needs to be refreshed or recalculated. And so if you've got 20 columns between the name and the salary, then a change in any of those columns will result in VLOOKUP being recalculated, whereas index match will just stay as it is because the name and salary aren't changing. So these are, I guess, minor differences, but again, it highlights that extra level of professionalism between using an index match versus a VLOOKUP columns. That being said, VLOOKUP columns is still far better than using VLOOKUP with a hard-coded reference. So if you really like VLOOKUP, just make sure you do it properly, okay? Now, there's an extra step to this. This itself is reasonably professional, but if I were to add in Faye to this list, Faye is earning some different salaries. If I were to now to type Faye into my inputs, nothing works right now. Classic VLOOKUP or any sort of lookup type problem. I've got new data, my formula needs to go and be stretched out to add the extra row for my new data set. Often what you'll find is every month, someone needs to go through and open up the models, drag all the formulae to extend the extra rows, and then you refresh your reports. Again, very amateur corporate sort of way of doing things. A consultant would look at this and say, wouldn't it be nice if you had formulae that would automatically extend? That would be the professional approach to solving this problem. And we can do this by turning this range here into a table, clicking the insert button on the ribbon, and then inserting it as a table. Now, a table is not just a garish looking thing with blue and white that's kind of ugly, that overwrites your formatting. A table is a specific structure in Excel that allows you to designate headings, allows you to designate values, and it has a clear start and a finish. You can see from the formatting where the end is, but you can also see there's a little icon in the bottom right-hand side of the table that tells you where it finishes. Now, the big advantage of a table is that when you type in more data and you've got values, you've got formulae that refer to the entire length of the table, they will usually automatically update to pick up any new values that get included. There you go. Isn't that cool? Incidentally, VLOOKUP usually works when I do this. In this case, for some reason, it's not worked. But that being said, generally speaking, if you're referring to the entire length of a table, it should automatically update. So you can see how it's worked here in the index match function. If I were to build the index match function again, let's index the salary. Ooh, look what's happened. It's actually, instead of referring to D3 to D8, it's saying, go to this table and find the salary column. And what you'll find is that this is actually easier to follow than different cell references. So now the formula is a little bit longer. Let me scroll across. You can see this second index function is longer than the first index function, but it's much easier to follow. Find from the salary the result when you find Faye's name from the name column. And here it's really easy. You don't need to think about what is B3 to B8, what is D3 to D8. It also means that when I add in new items to the table, you can guarantee that it's going to look through the entire length of the table and not get caught up at a certain row. So these are all tools that you can use to make your lookup functions that much more professional. Okay. Again, if anyone has any questions as we're going through these, feel free to drop them in the chat. If we can't answer them because it breaks the flow of the conversation too much, then look, we're happy to answer them at the very end as well. Okay, let's move to another example. Why don't we take a look at this model example? So this is an example of a simple financial model. We've got revenue, COGS, OPEX, EBITDA, depreciation, EBIT, as well as a quick calculation for what is depreciation. This is something that would have been put together by someone who might be applying for a job. We've said, here are some assumptions, put together and calculate the earnings before interest and tax. So there's the line that they would have calculated as a result. Now, from my perspective, this doesn't actually look that professional, honestly speaking. There are a number of things that you might want to do to kind of improve the way that this looks. So I'm going to make a copy of this and start making some changes here that adjust how it is that we're going to be looking at these. And the first thing I want to do is adjust the number formatting. So let's call this formatting. Now, you can tell that these are all general number formats because you've got these inconsistencies in the way that the different numbers are being presented. Usually what you want to do is have numbers that have, let's see, comma separators. Spell that correctly. Separators. you want to have things like a fixed number of decimal places. That might be 0, it might be 2, whatever it is. Having this consistency of decimal places is important. You want alignment of decimals. It's often the case that you want brackets for negative numbers. And also dashes, which are these things, for zeros. So these are things that help make a financial model look more professional. So rather than just having numbers as you see here, we have much better presented numbers. So I'm going to select these different items here. And in fact, let's select everything down to the end of the page, all of the dollar value numbers. And let's go to our number format and start playing around with these. What are the different things that we want to change? Let's select this cell up here, just so we can see the list on the right-hand side. So often we'll want to create a custom number format. First of all, let's get some comma separators in place. Standard comma separator, hash, comma, hash, hash, 0. Having the hashes, that shows that these numbers are optional. So if you've got a number like 300, it's not going to force you to have that comma and have that 1,000 value in place. So it won't be 0, 300, it'll just be 300. That's the purpose of using hashes rather than zeros here. Now, when you're dealing with number formatting, the number formats generally go positive numbers, then negative numbers, then zeros. And so we use semicolons to break these up. So if that's my positive number, I can have a negative number. Let's put some brackets in place. Bracket, hash, comma, hash, hash, 0, close bracket. And so if I have a negative number, it's going to be in brackets instead. Now, I said we needed a fixed number of decimal places. Currently, it's set to 0 decimal places, but if I wanted them to be fixed, I could simply put in .00 at the end of these different options as well. Again, 0 forces the number to be in place. So this will force all the numbers to show 2 decimal places, even if they don't have decimals. Alternatively, looking at the size of these numbers here, I think probably without decimals will look better, will look more professional. So I'm going to leave these without decimal places, so they'll all be 0, or 0 decimal places. Let's have dashes for zeros. So we've got positive, semicolon, negative, semicolon, and let's deal with zeros now. We're going to use the dash symbol, and that's going to be our zeros that we have in place. Okay, the final one that I want to talk through here is actually the third point that I listed on the right-hand side, the alignment of decimal places. How do we go about aligning these? Because if I were to just set this in place, what you'll find is that negatives aren't properly aligned with positive numbers. So we basically want space for a bracket in front and behind the positive numbers and the zeros. And we can do this by putting underscore open bracket and underscore close bracket. And likewise in front of the zeros, underscore open bracket, underscore close bracket. And what this does, this leaves us a little bit of blank space so that the numbers and the comma separators and everything will line up properly. So with that in place, I'm happy with this. I'm going to copy this just so I can put it on the right-hand side to make it easy to see how you can set that up. Number format, that's what we're using right now. And you can see everything looks really nice and neat. If I were to put in a negative number here, you can see all of the units, tens, hundreds will all in perfect alignment. If I made that negative 10,000, you can see everything lines up perfectly. That's because of these underscore brackets that we have in place. So some simple number formatting already makes this look far more professional than it did previously. Okay, I'm going to copy everything we have here. We're going to put it onto a new page. And we're going to look at another form of adjustments that we can use to make this look more professional. One common format that we see is to have revenues or cash inflows being positive and expenses or cash outflows being negative. currently, the way this model's been built, it's got revenue as a positive number, COGS as a positive number, OPEX as a positive number. And EBITDA, therefore, has to work out the revenue minus the COGS and minus the OPEX. That's less than ideal. When you get into looking at, say, net interest, is net interest something that should be added, or is net interest something that should be subtracted? It's really hard to know. So ideally, having that process of saying a positive number is something that's good for the company, a negative number is something that's bad for the company in the financial statements is a much better way of approaching it. So rather than have positive numbers through here, I would rather like to see these as negative numbers through here. Likewise with the OPEX, I would rather see this as a negative number. I'd rather see the depreciation as a negative number. And then all of my EBITDAs, instead these could be simply sum going down through these pages. And let's sum this as well. And so the end result is exactly the same as it was before. But the difference here is now we can see which are the inflows and which are the outflows very easily. Again, professional move makes things look clearer for the user at the end of the day. It might be easier to say, look, I'm calculating my depreciation in positive terms, so I just want to present them in positive terms up in my financial statements. That would be easier for a modeler. But for someone who's viewing the result of these models, the outputs, it's much easier to see these as negative numbers to show they're things that decrease your profit. So I'm going to rename this sheet and call this, let's call this fin statements. Just to show that a slight tweak to the way we present our financial statements makes it a lot easier to follow. Okay, again, I'm going to copy all of these cells. I'm going to create a new sheet. And we're going to introduce a new concept. We're going to, in this sheet, we will make some modifications around styles. So you might recall that when we had our key concepts of financial modeling, there was one thing around, I guess, or two things really. One is consistency, one is transparency. Making sure that it's really clear for users to understand what are the inputs, what are the things that have been hard-coded that we should, or that they should be able to change and update and adjust. And so here's a really neat trick to find all of the hard-coded numbers on your sheet. If you go F5 or Control G, this will open up the Go-To menu. When you've got this, you know that this is a really special trick because it requires you to click on the Special button in the bottom left-hand side. The Special button basically allows you to select different types of cells in the workbook. So normally the Go-To function allows you to type in a cell reference and it selects that cell reference. Here, what we're going to look for are constants, things that are hard-coded into these cells. And, you know, there's a whole bunch of labels on the left-hand side that are also hard-coded. Maybe we shouldn't be including those. So I'm going to deselect text, logical, and errors. We'll only look for the hard-coded numbers. For those people who ever have issues when someone takes your spreadsheet and hard-codes numbers in place and you don't realize where those hard-coded numbers are, this is how you find them. F5, special, constants. If I hit OK, we'll quickly see that all of the hard-coded numbers in the spreadsheet are highlighted. This gives us the opportunity to either put some formatting in place or alternatively, in fact, better yet, use styles. I've got a custom style here that allows me to tag these as assumptions. These assumption cells are now clearly identified as being things that can be changed by a user. Everything else in this row are calculations, but this number, I can adjust that to be 5,000 instead of 10,000. And that's a perfectly allowable thing. This highlights the flexibility of our spreadsheet. Here are the assumptions that should be able to be changed. So those are the styles. Let's see, what else can we do with this here? Maybe we should try and pull these assumptions into a separate part of the worksheet. So let's copy everything here. we'll create a new sheet for this, and let's call this inputs. And so what I'm going to do, I'm going to insert a bunch of rows at the very top, and I'm going to say, what's my revenue input? My revenue input is going to be $10,000. Let's undo that. My OPEX inputs are going to be $4,000, $5,000, and $6,000. Generally as well, again, thinking about user friendliness, when someone enters a value in for what are my costs, they're not thinking of it in terms of, these are my costs in negative terms. They're going to think of it in positive terms. So I want these assumptions to be in positive numbers for those operating costs. And when I have, what else do I have? Depreciation rate, purchases. I'm just going to copy and paste these and put these at the top here. So if these are my new inputs now, I'm going to have a formula in place of the assumption. That's going to be equal to my revenue input. And then I'm just going to copy the formatting back over from the right-hand side. I'm going to have a formula here that for my OPEX, these are equal to the negative of the input, so that they're negative in our financial statements. And again, I'm just going to copy the formats back over again. Depreciation, it's going to be equal to the input depreciation. Purchases, they're going to be equal to the input purchases. And again, we're just going to copy the number formatting back over. I'm going to copy the number formatting back over, but I'll make that a percentage again. And so now we've got this section that's clearly inputs. And you know what? We can use our styles again to show this is the input section. As separate from these are the calculations. And here you go. In the space of a couple of minutes, I've basically moved all of the assumptions into this block over here, leaving our calculations free of inputs. So if anyone wants to make any updates to the model, they know that they can go to this input section and subsequently we'll see the results in the calculation section. Okay. However, there's another element here which refers to the hard coding in these cells. You'll see that there's some hard coding around the growth rate of revenue and the amount of COGS and the growth rate of your OPEX. So it's not just the case of saying the inputs are those hard-coded values that were typed into the cells, but there are also hard-coded values through the cells as well. So we're going to need further assumptions. So let's have revenue growth. That's going to be 10%. We've got our COGS of 0.35 here. That's 35% of revenue. So the COGS percentage, again, new input, COGS as percentage of revenue is going to be 35%. And then maybe we can have one final item for the OPEX growth, which is also 10%. And then I can go back into these formulae, and instead of having these hard-coded 10%, I can refer back to the input. For COGS, instead of having this hard-coded 0.35, I can refer back to the input, anchoring that and copying it to the right. And finally, for OPEX, instead of that 10%, I can have this input instead, copy to the right. And for those who aren't aware, the shortcut that I'm using to copy things to the right is Control-R. That takes everything in the first column that you have and copies it all the way across the row that you've selected. That's a really neat shortcut that speeds things up. So here are my inputs. These are my calculations. And now nothing here is hard-coded. Everything has a reference back to an input, which is much better. Okay, I'm starting to run out of time, so I'm going to quickly go through one final comment that I want to put through this model, which is to work on consistency. Because right now, having the inputs and outputs separate, on the face of it, this looks like a decent model. But when you actually break it down and go into each calculation area, you'll see that there are some serious issues. So let me, again, copy all of this out into a new page. And we'll call this page consistency. We're going to jump to the calculation section because we want to see, are these formulae consistent? Are all the formulae here consistent? And we're going to go back to that trick I was showing you before, the F5 special trick. Because within F5 special, there is a really cool tool called row differences. And what this will do, this will highlight any cells that don't match up with the first column in the row. So if I hit OK here, you can see this is highlighting that these formulae are different from that first cell. These formulae are different from these first 3 cells. All of these formulae here are different from what you see in the first column, which is the 125 or these zeros in the rest of the grid. So these are cells that we want to change and adjust. So I'm actually going to highlight these cells because I know these are the inconsistent cells that I want to try and fix up. So what are we going to do here? We want a formula here that's going to say, if you're in the first period, this year 1, then set it to be $10,000. Otherwise, use the growth rate of 10%. So to do that, I'm actually going to create a new item at the very top, which is a counter that's going to count how many periods have we gone through our model. Because that way I can say, if this is year number 1, take $10,000. So instead of having a formula that just takes the 10,000, let's say if that counter equals 1, then we'll have $10,000. Otherwise, we want to take last year's figure and escalate it by the 10% input instead. So we'll take last year's figure times 1 plus 10%. And in doing this, again, I'm going to select the cells to the right-hand side and hit Control R. You can see the number is exactly the same, but we now have one formula that goes across the entire range, consistency. Let's look at OPEX, and let's do the same thing. This time, it's not so much that in period 1, it's going to be using this assumption, but actually, it's if there is a number in this input row. So we're going to have a formula here that says if is number, this is the function that we're going to use to look for a number. If that's a number, then let's take the negative of that number. So we've put in 4,000, we're going to have negative 4,000 come through as a result. If there's no number there, then let's look at last period's OPEX, and let's escalate that by 10%. And again, if I were to select the entire row and hit Control R, that's all going to copy across. The formula on this side still the same, giving us the same result, but we now have a consistent formula across this block. Brilliant. Finally, here we go. We've got a formula here, and we can see that this is using a depreciation grid style of approach. Which is really common, but isn't very professional. Like this is a sign that someone's worked in corporate and they've done something to get the answer, but don't necessarily know that there are neater ways of doing it. So why do we have a play around here? Let's come up with a new function that not only copies to the right, but actually also copies down the page as well. That would be really nice. So we're going to set up this formula, and I don't have this to hand, so I'm going to do this off the top of my head. Let's go. First of all, if this counter, I guess, is after, oh, no, how's it going to be? If the counter is before what year of CapEx this is, then it's going to be 0, right? So if the counter is less than the row that we're in, and I'm going to use the rows function here. Rows, A39 to A39, then that's 0. So if we're in year 1, but we're looking at year 2 CapEx, then you know what? That's got to be 0. There's nothing there. Otherwise, we're going to take 500 times 25%. But if there's actually a second condition here, if we're actually past where we're at, so if you think about the year that we're in, we know that with a depreciation rate of 25%, we only need to depreciate up to 500. We only need to depreciate 4 years worth of stuff. So I'm going to put a new rule here in, and that is that if the counter, which was C2, if that counter is greater than, and again, we're going to look at the rows that we have, rows A39 to A39, plus 1 divided by the depreciation rate, because that's going to tell us how many years we're going through this. So we're in year 1, we've got 4 years worth of data, so that's 1 plus 4 is 5. If it's greater than 5, actually that should probably be if it's greater than or equal to 5, then that's also going to be 0. Otherwise, we're actually going to get the result, which is 500 multiplied by the depreciation rate. Now, we want to make this, well, this formula will work for this cell, this specific cell, but I want to be able to copy this down the page and across the page as well. So we're going to need to make sure that all of the anchoring is done so that we can copy it across and drag it to the right, as well as drag it down. So we'll anchor the reference to C2 by just anchoring the rows to C2. When it comes to the rows function, we want the first one to be definitely anchored to A39, but we want the other 39 to carry down the page as well. So it's going to pick up 2 rows, 3 rows, 4 rows, 5 rows. So we'll just anchor the column for these. For B35, this definitely needs to be anchored properly. B35, again, needs to be anchored properly. This B39 is referring to this column B, but row 39. Now, this row needs to change, but the column needs to stay in place. So I'm going to anchor just the column here. Now, hopefully I've done this correctly. I should be able to copy this to the right. You'll see that I get 4 years of depreciation, then 0. And when I copy it down the page, we should have that beautiful depreciation grid and have zeros in all of these cells down here. So we now have one formula that covers all 5 different years. We don't have this sort of step staggered approach of one formula here, then a new formula there, and then suddenly the formula stops at different places. This is much better. Now, this formula itself is not necessarily the best formula. There are actually other useful tricks that you can use to make this more efficient and more professional looking. But I just want to highlight this in the context of consistency specifically, that this is a way that you can make it consistent. Again, I'm not necessarily advocating this formula in particular. I'm just saying that we want to make this consistent. So if I were to sort of zoom out and go back and look at this calculation area, and I say, is this consistent? F5, special. We're going to look at row differences and hit OK. We can see no cells are found. Brilliant. That means that there are no problems. All the formula consistent across the entire rows, and we've solved our need. And so if we're now looking at this as a file, so I've zoomed out a lot so you can see it from top to bottom. You can see we've got our inputs here, we've got our calculations, and I can see that everything is consistent across the calculation time period. And you compare that back to the start file, which just has a bunch of numbers that's not very well formatted, that has these hard-coded numbers mixed in with the calculations, with hard-coded numbers in the calculations, with big blocks of inconsistent gaps in your calculations. You can see there's a world of difference between this application and this application. So as a potential employer, if I'm looking at someone and I'm judging these 2 files, I'm going to probably ignore the first file and I'll invite this final file in for an interview. So hopefully this gives you a sense of what it is that you can do to build I guess, professional models, right? We've highlighted, going back to the agenda, let's quickly jump back to the agenda quickly. We've highlighted, I guess, the best practices about how to look like a professional modeler. We've we've taken that through some different examples. We've looked at how you can use a basic VLOOKUP function and tweak that to make it look more professional, and use slightly different tools to make it look more professional, to actually go to the data source and adjust that so that it automatically updates. And that's like the ultimate in professionalism. And then we've taken a model that would have worked and done the job and given you the right answer, but made it a much more professional model, splitting out those inputs and calculations, making that formula consistent, adjusting all the presentation and using styles to make it really consistent, and formatting, make it more transparent, easier for users. Going back to those 4 key points: consistency, robustness, flexibility, transparency. Applying those 4 techniques made that file a lot more professional as a result. Hopefully, you've also taken away some useful tips and checks that you can apply to your files, such as that F5 special row differences, F5 special looking for constants throughout the page. Hopefully, those are some useful tips and checks and tricks that you can apply to make sure that what you're producing for your clients, for your colleagues, for your potential employers and so forth, look far more professional than they might be looking right now. And so with that, this is basically going to be the end of my particular presentation. You're told to stick to an hour. Hope I've gone slightly over an hour, I think, but hopefully that'll just eat a little bit of the question time, and we're now in a position where we can try and answer questions that people have. Hopefully we can do that quickly. So Nidhi, I'll pass it back to you now. I finished my presentation. Do we have any questions from the chat that have come through in the last hour?
Yes, sir. We have got a question. What is the last attribute in the formula 0? Like, I guess this question relates to number formatting.
The last attribute in the, sorry, what was the question? The last attribute in the formula or the format?
The last attribute in the formula 0, the double quotes 0.
0. Okay, so I'm assuming that they're actually referring to the VLOOKUP, and that this is the false versus true. So a lot of people use 0 rather than false, because 0 is 0 is the equivalent of false, and 1 is the equivalent of true, and they're kind of interchangeable in that regard. So what is the purpose of the 0? Well, first of all, let me change this back to Billy here. This is an exact match versus an approximate match. So when I remove that, hopefully everyone can see that we've got this tooltip update for true versus false. False is an exact match. It'll look and make sure that it'll only find exactly Billy spelt in this way, B-I-L-L-Y. If I change this to an approximate match, then what this will do, it will actually search for something that is approximately Billy. Now, it's not the way that a lot of people think it is, in that it's not going to look at Billy and say, oh, Billy sounds like this Billy, so it's going to give me the value for 60,000. No. The way the approximate match works is it firstly requires this data to be sorted in alphanumeric order. And secondly, it's going to look for the value that is the biggest possible, that is smaller than the value that you're searching for. So the best way I can think of to actually show this as an example is if I have different years. Say if I've got 2020, 2021, and so on out to the right-hand side. If I'm searching for 2023.5 or 2023.8 even, let's match where this value is in this range. Oopsie, let's match that in this range using that approximate match. Let's go 1, 2, 3. Let's drag this across because I'm lazy. 2023.8 is somewhere in this range here. It falls between these two numbers. Now, a lot of people will think that 2023.8 should round up to 24 and we should get the 5 value. But actually, what it does, it's searching for the biggest number less than 2023.8, which is going to be 2023. And as a result, that approximate match gives you the 4th result in this list. And that's basically the difference between approximate and exact. Most of the time when you're using a VLOOKUP, you want to use an exact match because you're looking for exactly the value that you're searching for. But often, especially when you're looking at dates, you'll want to see what is the latest value. So if I have a list of dates, let's say today's date and today's date plus, let's see, 8. Let's say there's another one that is the 23rd of the 8th, 2020. There's the 15th of September, 2020. And these all have different values. If I want to know what was the balance at 1st of September, 2020, I can use, let's see, VLOOKUP, looking for this value in this table. Again, I'm just hard coding it quickly, so don't mind the fact that I've hard coded this. But let's use a true approximate match. And what this is going to do, it's going to find the biggest value that's less than the 1st of September. So if your bank balance was $100, $200, $300, at the 1st of September, that's somewhere between these two dates. So you're going to return the value of 300. That was your balance as at that time. This is probably the most common way to see where the approximate match will actually be used. It's not used very often because most of the time when people use VLOOKUP, it's to find a specific result in a list, but approximate has a very useful place in the world. Hopefully that answers the question. Okay. Nidhi, what else do we have in the questions?
We have no further questions, sir. So
no further questions. Excellent. Okay. Well, if anyone has any other questions, I'm more than happy to hang around for the next 15 minutes and try and answer them as they come through. If anyone has any questions. Otherwise, Nidhi, I'll pass it to you to either read out any further questions or to start wrapping up, whichever you think is appropriate.
Tim, Prasad here. Apart from the formulas, what we discussed here, can you let us know some other important formulas that professional modelers can use? In general, in general, what commonly used formulas which would be useful for professional modelers?
Yeah, no, absolutely. Other common formulas that are used. So, I mean, probably the most common ones are your index and match, which I've talked about before already. I think that SUMIFs is probably a really useful function that most people need to be aware of. SUMIFs instead of SUMIF, I suppose. So SUMIFs is allowing you to do a SUMIF, but across multiple different criteria. I think that's really important. And it's another way that you can actually apply a lookup. So if I were to use SUMIFs here, that would be SUMIFs looking at the salary where the name is equal to Billy's name. Because we've got Billy, i.e. there's no result, but if I change this back to Billy, this will give me a result just the same way that index match does. Difference being that one will give me duplicates. So if I put Billy's name in a second time, that will potentially cause a problem with SUMIFs. But whereas index match will give me that very first function, which is slightly different, right? So there's a difference in approaches to the way that SUMIFs and index match deal with the problem. If you're on the most recent version of Excel, so if your Excel is up to date, you'll have access to XLOOKUP as well. XLOOKUP is kind of the spiritual successor to both VLOOKUP and index and match, and works much better because you've got a single function now that I can use to find Billy's name in this list, this list over here, giving me this result over there on the right-hand side. And that just gives me the answer, nice and simple. If I were to add in some extra handling, I could say if I can't find the result, no name found, which means that if I were to type in that Billy, i.e., instead of getting a hash and a, I don't need to have any sort of if error function around my XLOOKUP. It will just automatically give me the end result, no name found, which is brilliant. The only problem with this is that XLOOKUP requires you to have Office 365. And so again, if you're thinking about it professionally, it's nice to be able to show off that you know how to use this function and that you're up to date with all the latest, greatest things in Excel. But if your employer or potential employer is using Office 2013, 2016, this isn't going to work. So, trying to show off this fancy tool is not going to be beneficial to you as someone who's building spreadsheets. So I think those are more the key tools when it comes to modeling. Most of financial modeling is really about trying to find better ways to do things. So instead of using, say, nested if functions, instead of going if this, then that, and then if this, then that, and if this, then that, and if this, etc., what you might do instead is have a set of rules that say, first if condition is this, true or false. And then the second if condition, true or false, and so on. And these true or falses might actually be ones or zeros. And then your final result can simply be the maximum of all of those results or the minimum of all of those results. And that will effectively tell you whether you've met all of your criteria. And so instead of having this giant nested if function, which is not very transparent, it's not very robust, it's hard to audit, then you've got this checklist of if conditions that need to be met and a result. And it's much more transparent because you've got it all laid out across multiple rows. So this is a really neat way of trying to avoid some of the giant mega formula that get created when you've got a lot of conditions by breaking them out into separate conditions and combining it using just your basic max or min functions instead. I guess the only other thing that I think a lot of professionals will use nowadays are tools like Power Query. So if you go to the data tab, you'll get data. These are the tools that you want to use to go and connect workbooks together and connect to different data sources. You see a lot of people using like VBA to try and do this, or external workbook links. That's really poor practice, or a bit old school. Nowadays, get data, Power Query is much faster and much more streamlined at being able to sort of integrate it into files with lower risk. So those are some of the different functions and features I think are really useful for modeling generally, that kind of showcase you as a professional rather than you as just someone who's hacked up a result that gets you the answer. Does that answer the question?
Thanks, Tim. That answers the question, and you have given us some excellent functions. And also, as you said, unless we have the latest version, some of the functions might not work. Yeah. Thank you.
That's right. So one thing to note, Power Query is available in 2016, which is why I'm happy to kind of really push that as a useful tool to link up files. It's available in 2013 if you're using the right version. So you need to be on Professional Plus to access 2013 Power Query. Actually, no, 2013. No, 2013. I think you just download the add-in for it. I think there's just the add-in that you download for it. So that one's pretty straightforward. If you haven't used pivot tables or Power Pivot, that's also a tool that I would highly recommend using. Not so much in the way of financial modeling, but probably more in the case of financial reporting, when you're getting large data sets and trying to summarize and aggregate that data. Power Pivot's really invaluable for that.
Thank you, Tim. Thank you. Over to you, Didi.
Thank you, sir. That was indeed an informative session. On behalf of Excel in Excel, I thank you for sharing your wisdom. And to the participants, thank you so much for joining us. Just an announcement for all. On 14th of August, we have a session on automate sending emails from MS Excel using VBA scripts by Patrick Samborski. And on 21st of August, we have a session on time for automation, Power Query and Power Automate by Faraz Sheikh. Again, thank you everyone for joining us today. And for those on YouTube, do not forget to like the video and subscribe our channel. All links are there in the description box. Stay tuned for more fresh talks, and thank you everyone. Thank you, sir.